Hey, welcome back to Zap Financial. My name is Gilbert. In this video, I want to show you what a properly designed small IUL policy looks like. Now, small is a relative word, so what's small to one person might be big to someone else. But in this case, it's a $300 a month policy. The reason for this video is because recently someone reached out to me and said, most IUL examples I see are $15,000 a month, $20,000 a month. I cannot afford that. So in this video, I'm going to show you that yes, a small policy can absolutely work. It can be efficient if it's designed properly. So in this example, our goal is maximum cash growth and policy efficiency. So here's the setup. It's a 30-year-old male who wants to fund a policy $300 a month or $3,600 a year. And then no extra funding after 25 years. Now, if you've watched any of my videos, you already know I always talk about blending term insurance. That's the key to reducing the expenses in an IUL. So in this design, we have $25,000 base insurance and we have $75,000 term insurance. That's the blended term insurance. This a 3-to-1 blend, which is the maximum allowed for this product. So one part of this to 3 parts of it. Okay. This is how you reduce the expenses and make your IUL policy efficient. So in this illustration here, you're seeing that we have 2 scenarios here. We have a very conservative illustration, which is assuming 3.5%. And then we have the one on the right-hand side, it's assuming 6%, which is typically what we are looking at long-term. Okay, we're not thinking IUL is going to yield 8-10% over a long run. No, I believe in that myself, but 6% is somewhere like a sweet spot. Okay, so that's sort of what we are looking at here. Now, if you look at this here, by the end of year 1, we put in $3,600. We have a little bit over $3,200 into the policy, but the cash surrender value is about $2,800. What that means is if you were to cancel the policy by the end of the first year, then you're only going to get $2,800 out of the $3,200 you have in the policy, which means there is a surrender charge of about, let's say, $400 here. That's something that is part of every IUL, but it lasts for a certain number of years. In this product, you can see that by the year 11, both of these numbers are equal. And from that point forward, there's no surrender charge. Okay. One important thing to pay attention here is that you can see that our cash surrender value is quite high compared to the amount of money we are putting into the policy. Most of the time, small policies, you likely will see a 0 here and the agent will tell you that's how it is. Most of the time, it could be because of the product. The reason I chose National Life because they allow you to do a small face amount or the small base insurance and then blend in term insurance. So if you're funding something very small, National Life is sort of a good product for that kind of funding. But if you are doing a big amount funding, there might be other products that may work better in that situation as well. We are using an increasing death benefit option here. So you can see the death benefit increases as our cash also increases. So let's say by year 10, you have $42,000 in cash sitting in a policy and the death benefit has increased from, remember, $100,000 here to $142,000 here, which means that the cash is already added to the death benefit. Sometimes you hear people say, oh, the insurance company will keep your money. If you have an increasing death benefit option, you are getting the cash plus the initial death benefit. Very important detail here. The cash in the policy plus the initial death benefit. Okay. Now, if there are any loans outstanding, then we are going to deduct the loans from that as well. So this is something you want to understand because there are a lot of misconceptions out there. People say all sort of stuff when they don't really know all the specific details. So it's quite important to know that. The next thing that we want to look at is the actual expenses in the product because this is where sometimes people get confused. They don't understand it. Maybe agent is not explaining it. So let's look at it. Okay, so this is the expense page. You can see sort of a lot of columns here, but we're going to break it down and make sure you understand it. So let's zoom in here a little bit. So like I said, $3,600 a year goes into the policy. The first is the premium charge. Okay, this is a fixed percent that comes off the top any money you put into the policy. So you can see two different numbers here. The first 10 years, we have one kind of number, 288. And then after that, it drops to 180. And the reason is this: in this new National Life product, it's 8% the first 10 years, and then it drops to 5%. So any money you put into the policy, 8% comes off the top the first 10 years. And then from there, it drops to 5%. Okay, cool. The next column that we have is the cost of insurance. So that's the cost for the actual life insurance protection. Okay, so that's these amounts here. I mean, this is a 30-year-old, so it's quite low. And this is one of the reasons why you get an IUL policy as early as possible. You can see that over time, it's going to gradually go up. Now, sometimes people scare you that it's going to blow out of the window. These are some of the little misconceptions people have. Yes, compared to where we started it from, what we had around 18 to 600. Yes, it's quite high, but if we look at the amount of cash sitting in the policy at that time, 600 is barely nothing. Okay, so yes, the cost of insurance is going to go up, but the unit amount you need drops and drops, and so the cost is not something that's going to blow up, especially if it's designed properly. This is one of the misconceptions always people try to scare you about. As far as IUL meets your use case, it can be a good product. It's not for everybody, and there's no financial tool that's for everybody. Okay, so you want to understand the use case and make sure it works before you get it. The next cost is the policy fee. The policy fee, think of it like a documentation fee. Insurance companies have to mail checks, they have to send paperwork, all these kind of stuff. It's sort of spread out. Everybody pays for it, whether you use that kind of service or not. But it's $72 a year in this policy, and it's going to be there as long as you own the policy. Okay. The next thing is the expense charge. This is the insurance company recouping any cost they incurred to put the policy in force. Sometimes people have to do tests, and also agent commissions, because agent commissions falls under this. And this is where, if your policy is not designed properly, you are going to pay a lot just because an agent did a bad job. That's so sad, but that's sort of how it works. In this product, it's recouped for 10 years. Now, remember, we did a blended design here, right? If I was to put in the $400,000 as base insurance, then this expense charge, I believe, was around $267, and it's going to be, you're going to pay $267 for 10 years. So design really matters, because bad design means more expenses in the policy that is not really necessary. Okay, so that is what the expense charge is for. Insurance company recouping any cost they incurred to put a policy in force. Now, the next one is this accumulated value charge. Now, this is not in every IUL product. It's in just a few products here. But this is a fixed percent of any money you have in the policy, the accumulation value. It's 0.04% each month. So whatever money you have in accumulation value, insurance company is going to calculate 0.04% every month. And that expense is the accumulation value. So you can see that the more the accumulation value grows, it means this charge is going to increase. Think of it like asset under management, sort of how investment works. Yeah, but this is going to be for 25 years. So the first 25 years is 0.04% every single month. Okay, whatever money you have sitting in the policy. So that's about the expenses. When we add everything up, the first year, 463. 463 out of your $3,600 is going to go towards expenses. That means that if somebody were to fund the policy just $500, cool, they'll be okay. But the problem is that there'll be barely anything left. That $500 will be eaten up by expenses in the product. And so even if the IUL performs 10% or 12% that year, they will miss out on the gains. These are some of the things that will make IUL not perform. The design can be great, everything is fine, the index performed, But just because you didn't fund your policy, that you're going to miss out on the growth. And you do not know which years you're going to get the growth and which years you're not going to get it. Some 0 years. So that's why consistency in funding is so important. So you need to make sure you are funding your policy, especially the first few years when the expenses are a little bit high, when insurance companies recouping this cost. They are going to be there. Whether you put money in or not, the insurance company is going to recoup this cost. So fund your policy, especially the first, let's say 7 to 10 years, you really want to fund your policies. Make sure there's money in the policy to grow. The last thing I want to talk about is commission. I believe in transparency, so I cannot end this video without talking about commission. So let's take a look at that. Now, the word you need to look for when it comes to commission in any IUO product is the word target premium. Okay, sorry here, target premium. That gives us a measure of the commission built into the product. It does not necessarily mean that is what an agent is going to get. Now, depending on the agency, an agent may get somewhere between 30 to 100% of the target premium. Okay, so this is the target premium. But that is the commission built into the design. At the end of the day, depending on whoever get that commission, it doesn't matter. You are going to incur that cost in your design. You are going to pay for it. So whether an agent is making 30% or 40%, it doesn't matter. The cost of the design is going to be in your product and you are going to pay for it. So it matters that you pay attention to it. So here you see 242, we are putting in 3,600. So as a percent, about 7%. Okay, so that's quite low. That tells me that, okay, the cost in this product is okay. Now, of course, that's quite subjective, because if I were to give this same design to, let's say, somebody who is 45, the target premium is going to be higher. And the reason is because the older you are, the cost of insurance goes up. That's sort of how it works. So I cannot give you a hard and fast rule, but if, let's say, your target premium is $2,500 and you are paying in $3,000 into the policy a year, I can tell you that this is not going to be a good design. Now, sometimes that's what is going to happen depending on what a client wants, depending on certain situations. But it tells me that it's not the most efficient policy design. Now, again, don't hold me to this. This is sort of a way to kind of keep an eye on there, okay? But if you're not sure, if something doesn't feel right, talk to somebody else and let them explain to you, or talk to your agent and let them explain to you, or seek a second opinion from somebody else. I'm more than glad to help you out with something like that. Once we minimize the expenses in the product, then we give ourselves the best shot. Think about this. Any expenses built into the product will always be there. You cannot get around it. But a properly designed policy should reduce all these expenses. A good rule of thumb says fund your IUO policy at least 10 times your age. So you're 30 years, then you want to put in at least $300 a month into the policy. Like I showed you here, right? The cost that we saw in the first year was what? $463. So even if you put in $500 into the policy, you'll be okay, but no growth for you. But if you put in $3,600, then you have quite a bit left over after this expenses, and that gives you a chance to grow. So that's all I have for you to get. If you have any questions or any topic you want me to cover, let me know. I'll be more than happy to do that. Put it in the comment section below. And if you have something you want to talk with me one-on-one, in the description below, I have my link there. I can meet with you and answer specific questions that you need to know. Maybe you're not even sure if IUL is good for you, and sort of figuring that out, I can help you out make the decisions, looking at your overall financial picture. But I appreciate your time with me here today, and I'll see you in the next video. Bye.